Should I contribute to my Roth IRA or my traditional IRA? Let's break it down on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning into this episode of the Hawaii Retirement Show. Today's episode, we're talking about Roth versus traditional. We're focusing kind of on the Roth IRA and traditional IRA here, but this topic can pertain to, just about any retirement account. TSPs, 457s, 401ks, SEP IRAs, your solo 401ks, 403bs, any sort of retirement account that offers this Roth and traditional options, right? It's how do I make that determination of which one is best for my situation? And to do that, there's a lot of variables that go into trying to answer the Roth versus traditional, and it's very unique and personal to each individual and each couple, each family, right? And, a lot of this, there's not a black and white answer because financial planning tends to leak into more of an art than a science. And what I mean by that is there's some variables that are just unknowns, right? We can't say for certain what the future might look like in regards to taxes. And with that variable being present, there's no guarantee that you're going to make the right decision to maximize your tax rates. But what I want to touch on is some things to consider to help you make the best educated guess towards what the best tax allocation is for you and if you should contribute to your Roth or traditional. So to start off, as it pertains to IRAs, you want to first determine if you are eligible to deduct your traditional IRA contributions. And what I mean by that is before you do anything, make sure that you're abiding by the rules, right? There's income limits according to your modified adjusted gross income for making deductible IRA contributions. There's also income limits to allowing you to contribute to a Roth IRA. And then there's contribution limits. There's catch-up contribution limits. And so first step is just kind of take a inventory of what options are available to you. And then also what sort of workarounds are there? If you're not able to do the traditional IRA deductible contributions, maybe you want to consider doing backdoor Roth IRA contributions. There's a lot of different options available, but first take inventory of what options are available to me given my my situation, my age, for catch-up contributions, and my modified adjusted gross income. So then you want to kind of look at, and this is where really the art comes in, is do you expect future marginal tax rates to be higher than current tax rates? And that's a tough one. And what I mean by that is most people would say, yeah, we think that future tax rates will go up, right? We can't see a world in which tax rates would go down. And in my personal opinion, I don't disagree with that. However, there's a lot of different ways for the government to generate revenues that don't necessarily utilize increasing marginal tax rates across the board, like increasing tax brackets, right? Maybe it's something like, the net investment tax, right? The NIT there. And if you're over a certain threshold, you pay, an extra percentage on your investment taxes, right? That's a way where you didn't change the tax brackets per se, but you found a way of adding some sort of caveat and additional tax to a certain select group of people. So that's something that's where the art comes in. What do you envision future marginal tax rates to be? Do you think they're going to be higher, the tax brackets, in the future? And then you got to look at just personally, do you think you're going to be in a higher tax bracket situation in the future? Some people, when they retire, if they're high earners, you're going to see your income, taxable income drop because you retired, you stopped working. And this all factors in because traditional IRA distributions or traditional TSP, 401k, any of those distributions are taxed as ordinary income, right? They count as ordinary income, whereas the Roth does not. But you could say, well, I'm a high earner. I'm going to take these tax deductions now, if I can, and then with that money I saved, I'll be better off in the future because I'll be in a lower tax rate. So again, it gets a little complicated, a little abstract when you start to predict in the future what these numbers will be, and we really just don't know. The other thing to consider is RMDs when it comes to this. So when you're trying to figure out, okay, Roth versus traditional, should I pay the tax now? Should I take the tax deduction and pay the tax later? A big factor to consider is RMDs. So Roth accounts, and this now applies to Roth TSPs, 401ks, 457s, right? They don't need to be subject to RMDs, whereas traditional IRAs and your tax deductible contributions to your 401ks and TSPs, they'll be subject to RMDs, meaning some point down the road, you're going to be required to start pulling money out, whether you need it or not, and pay the taxes on it. And I did an episode a while back on RMDs. Take a listen to that. But that's another consideration, is kind of planning out, well, what will my RMDs make? So maybe you're contributing a lot to tax deductible contributions to your employer retirement plan, or you're making all these traditional IRA contributions. And if you find yourself really heavily weighted in these pre-tax retirement accounts, then eventually down the road, you're going to have to start taking distributions from that big sum of pre-tax money, and you're going to be taxed at ordinary income tax rates. And that's where you can kind of get into, conversions as well plays into this. Maybe you establish a plan where you say, I'm going to take the tax deduction now, and I'm going to plan for a time in my life here where I'm going to start to slowly convert that to Roth, meaning I'm going to make the conversion, pay the taxes on it, and avoid some of the big RMDs later on. But it's beneficial for me to take that tax deduction now. Also a possibility. The last thing I kind of want to get on is it's sometimes the best strategy is to kind of split the difference. And what I mean by that is there's a cohort of people who believe in having a diversification of taxable assets, right? So you want some in Roth, you want some in traditional, you want some in capital gains, your brokerage assets. And by having kind of your taxable allocation spread out between the three, you can kind of manage those. It gives you options of where to pull from to kind of manage those taxes in retirement. So there's a case to be made, a strong argument to be made for having a diverse, spread out allocation between Roth, traditional, and brokerage accounts, right? And if you're really hung up on, I don't know really how to parse this out and make the best decision, that might be the best route for you. And this stuff gets a little complicated. It can also be very simple, but it's always good to talk to a professional when you're going to make these decisions, especially if you're unsure of it. Some people are straightforward. I got it. I'm a Roth person. I just want sock away as much as I can in Roth. I think the government's just going to raise rates and they're going to try to take, as much money as they can. I just want all my money in Roth and let it grow tax-free. That's fine. And I'm not saying that's incorrect. But some people are a little bit on the fence, and it's definitely something to consider because those tax deductions, you can use that money, especially if you're a high earner, for other things in life, right? If you're saving money now because you're in a high income tax bracket, yeah, you're missing out on that tax-free growth, and there's RMDs and you'll pay the taxes later, but you're going to have a little bit more money in your pocket now, and maybe you can, if you're disciplined and intentional with your spending, you can use that to kind of better your financial situation in another way. So a lot goes into this. There's a flow chart that I'll put up on the website and the YouTube, But I think that wraps it up here for should I contribute to my Roth IRA versus traditional IRA. Like I said, this pertains to all retirement accounts, really, this discussion. And like always, if there's anything you'd like me to talk about on the show in particular, email it over to aloha@hawaiiretirementshow.com, and I'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.